Louis, thanks so much for your time. I mean, the topic that you're going to be talking about, selling your shares or tactics in a post-buyback world, why has this come as an important agenda at this Tax Indaba?
Well, so essentially the context is that about a year ago, there were some rules introduced to curb the abuse where companies sold their shares in other companies. There was basically some tax avoidance regarding dividends tax and capital gains tax. The rules were changed last year to curb the abuse. There were some unintended consequences, and then this year, Treasury has proposed amendments to the rules to prevent those unintended consequences from ensuing. And so this is what essentially will be discussed during the panel discussion on this issue.
All right, so essentially you're saying last year companies sold shares so that they wouldn't have to pay more tax. Why would they not want to pay tax to contribute to the fiscus, to contribute to a better economy? Why that avoidance?
Well, so it's essentially, any company, wants to obviously, maximize its profits and so forth. And the thing is that what happened is that, Treasury introduces rules and so on to incentivize certain behavior. It wants companies to make profits. The higher the profits, companies pay tax. What it does also want to prevent, though, however, is abuse. And what was happening was that companies were employing certain tax avoidance strategies a bit too aggressively.
Sure.
And in
order
to curb that, well, so simply put, what would happen is that, let's say, for example, I had a company and I owned all the shares in your company, 100% of the shares. And let's say then I wanted to sell my shares. I was a shareholder for 3 to 5 years. The share price grew by, say, when I bought it was R5. I bought 1 million shares. It grew by another R5. So in the normal course, if I sold all my shares, me as a company, I would make R5 million profit. So 5 times 1 million, R5 million profit. However, what companies then would do was, instead of just selling the shares outright, they would go and have your company, the company, pay a dividend to me. When the dividend is paid, that dividend from one company to another company is exempt from dividends tax. The effect of that is also that the share price could reduce, and as a result, when I then now sell my shares, any capital gains tax on which I would pay income tax, that is less. So whereas I would have paid on the R5 million profit I made, I now pay tax on far less, and that was happening too often.
I mean, is this a result of corporate tax and your capital gains tax and your dividend tax, just taxes generally in South Africa being a lot higher than what we're seeing in the rest of the world? Is this also the incentive for companies to not behave properly?
Well, potentially. I mean, obviously, I think it was interesting to note, I just saw an article where they was commenting on some of what the minister was saying this morning, and he was saying that, in the current economic climate where things are tough and we're going into a recession, companies want to pay less tax. There would be pressure on growth. I'm not an expert on the economic growth trends and so on, but obviously if a company is growing less, making less profits, it doesn't want to pay additional tax unnecessarily. So that could potentially be one of the reasons why they would do it. Like I say, the key thing is that Treasury generally does not have a problem with using incentives with companies trying to make profits. It's once the line is crossed where it becomes abuse, and that essentially was the problem.
Sure. You were talking about some unintended consequences of the measures that government introduced to curb such abusive behavior. What were they?
So essentially what happened is, aside from these anti-avoidance rules that we're discussing now, another very common and often used provision in the Income Tax Act is provisions regarding so-called corporate reorganizations. So essentially what companies would do is they would exchange assets for shares, or they would reorganize the interest within the company structure in order to move assets and so on. And generally what would happen within those is, because an asset is simply moved, Treasury would give relief and say, well, if a company within a group is merely changing shares for assets and so on, we're not going to tax you on that transaction now, we're going to delay it. And so once for example, the shares exit the group, for example, once that happens, then there'll be a tax. So what then unfortunately happened, the unintended consequence was that these corporate reorganizations generally are legitimate commercial transactions. But what happened now is that with the anti-avoidance rules regarding share buybacks, what would happen is that there would be, for example, a dividend declared, and the rule was then imposed that if you sell the shares within 18 months after the dividend. So if I use our example, I sold the shares to another company, and then obviously the value went down. So if I now, in that scenario, the anti-avoidance provision would say no, I would pay tax as if it were a normal sale, basically. But what happens sometimes is that I hold shares in the company in the normal course, a dividend is declared, and now 6, 8, 9 months down the line, maybe I want to exchange my shares in a general normal commercial transaction. And when that would happen, then that rule would trigger, and I would then be punished, even though it was never my intention to avoid tax. And that's one of the unintended consequences that they picked up.
Sure, I mean, it's sounding like such a complicated process, the way that companies go about doing this.
It is.
But then you talk about how, just lastly, finally, you said that now this Tax Indaba, you'll be talking about new measures now that the government plans to introduce to, essentially unwind those unintended consequences. So what are those?
Well, so essentially, and I come back to the scenario, if I carry out our example one step further, I sold the shares to the third party, or some of them, or let's rather change it slightly. Let's say I wanted to sell my shares, and the company declared a dividend to me, and now 8, 9 months down the line, I want to exchange my shares in your company for shares in another company. So as I say, as the rules stand currently, where I wanted to do that, I would be punished by the anti-avoidance provision. I would now pay a capital gains tax, but for doing a normal commercial transaction. But what they now want to bring in is two rules that will prevent this from happening.
Sure.
So where it's a legitimate commercial transaction, where I genuinely wanted to exchange my shares for other shares, that those consequences would not ensue.
Sure. Whew. Right. We will leave it there. That is why I am not a tax professional. That is complicated. Leave it to the smart people. Well, that was Louis Botha, who is an associate in the Tax and Exchange Control Practice at Cliffe Dekker Hofmeyr.